This is a critical exploration of the modern economy that challenges the conventional narrative around inflation. In this video, we present the argument that the current monetary and market structure leads to artificial price increases driven by concentration of power and financial extraction rather than organic supply and demand. Let's get started. The conventional explanation versus the structural power view of inflation. The conventional explanation for inflation, often summarized as too much money chasing too few goods, points to broad factors like expansionary monetary policy, central banks printing money, quantitative easing, supply chain shocks, events like the pandemic or wars disrupting production, strong consumer demand, stimulus checks and post-pandemic spending. While these factors play a role, the structural power view argues they are a surface-level explanation that obscures a deeper, more systemic driver, which is the exploitation of monopolistic and oligopolistic market positions. How monopoly power drives artificial inflation. The core of the argument is that inflation is not a neutral, organic phenomenon, but a managed process by entities with sufficient market power. This can be described by three core aspects. 1. The mechanism of price setting in concentrated markets. In a truly competitive market, a producer cannot arbitrarily raise prices. A competitor will undercut them. However, when a market is dominated by a handful of large corporations, an oligopoly, or a single one, a monopoly, the rules change. These large players have the power to set prices administratively, not based on their immediate cost of production, but based on what they believe maximizes their profit. They can collectively, even without explicit collusion, reduce output or hold the line on prices to maintain high profit margins. This can be masked by the inflation excuse. A period of announced inflation, such as from supply chain issues, provides a perfect smokescreen. A company can raise prices beyond what its own increased costs justify, blaming the economy while pocketing the difference. This is often referred to as greedflation or profit-led inflation. 2. The disconnect between commodity costs and end product prices. This is a crucial piece of evidence. Let's use a hypothetical example involving wheat and bread. From the perspective of the farmer, the producer, a wheat farmer sells a bushel of wheat to a giant food conglomerate. The price of that bushel may fluctuate, but it is largely dictated by the conglomerate. Due to their monopsony power, a single buyer in a market of many sellers, they can keep the price paid to the farmer low. From the perspective of the conglomerate, the processor, marketer, the conglomerate turns the wheat into flour and then into branded bread. Their cost for the raw wheat may have increased by 5%. However, they announce a 15% price increase for the loaf of bread, citing inflationary pressures. The result: the producer, farmer, makes less in real terms because their input costs, such as fuel or fertilizer, have also risen, but the price they receive for their commodity hasn't kept pace. Meanwhile, the end product cost, bread, skyrockets, and the conglomerate reports record profit margins. This demonstrates that the price increase is not a direct pass-through of costs, but a strategic decision to expand margins under the cover of a macroeconomic trend. Incidentally, we see this same mechanism used against employees with respect to wages, where the average wage of an office worker has remained unchanged for decades, while the market cost of goods and services has risen dramatically. All the while, corporations post record profits. 3. The role of the financial system and management waste. The modern monetary system fuels this in two key ways: through cheap capital for giants. Large established corporations with strong collateral have unparalleled access to cheap debt created by the financial system. They use this not necessarily for productive investment, such as for R&D or to provide higher wages, but for financial engineering, such as stock buybacks, which focus on using profits and cheap debt to buy back the corporation's own shares, artificially boosting stock prices and enriching executives whose compensation is tied to the stock. Or through acquisitions, by buying up smaller competitors, further consolidating market power and reducing competition. And through the emphasis of value extraction over production, the focus shifts from producing quality goods and services to extracting maximum financial value. This is done through price optimization algorithms, through software that constantly tests the maximum price consumers will pay, and also through shrinkflation, by reducing product size while maintaining or increasing price. And also through managerial bloat, characterized by soaring executive compensation, which is a form of value extraction from the company, as a cost that is ultimately passed on to the consumer in the form of higher prices. Why this system is self-reinforcing and leads to greater control. This is a system that leads to an increase in centralized control. It is a feedback loop due to the following factors. 1. Consolidation creates power. Initial mergers and acquisitions create large entities with pricing power. 2. Pricing power generates profits. These profits are not used to lower prices or significantly raise wages, but are funneled into financial markets. 3. Profits fuel further consolidation. This massive pool of capital is used to acquire or crush remaining competitors, lobby for favorable regulations, erecting barriers to entry, and invest in the control infrastructure through lobbying, data analytics, and political influence. 4. The cycle repeats. With less competition, the remaining giants have even more power to administer prices, leading to more profit, more control, and so on. The free market becomes a myth. It's not a market of many small players competing on quality and price, but a market of a few large players managing scarcity and consumer behavior. This phenomenon, often called greedflation, profit-led inflation, or seller's inflation, has been documented in economic studies and corporate earnings reports, particularly in the post-2020 period, the COVID era. The core mechanism is that in highly concentrated markets, dominant corporations have the power to increase their profit margins by raising prices beyond what is necessary to cover their own increased input costs. They use the broader narrative of inflation as a cover, knowing consumers and regulators will likely accept it. Here are several clear examples where this has occurred in a variety of economic sectors. 1. The food and agriculture sector. This sector provides some of the starkest examples of the disconnect between commodity prices, producer pay, and corporate profits. Product: beef. On price increase, retail beef prices saw significant increases. On raw material cost, the price of live cattle paid to ranchers did not see a commensurate rise. For long periods, ranchers complained of stagnant or even falling prices for their animals. On corporate profit and action, the meatpacking industry is dominated by 4 major companies: JBS, Tyson, Cargill, National Beef. These companies act as a bottleneck. They were able to widen their packer margin, the difference between what they pay for a live animal and the price they get for the boxed beef. They raised prices for consumers while keeping costs to producers low, leading to record profits. A Farm Action report detailed how in 2021, meat packers' net margins soared by over 300% while ranchers struggled. Product: consumer packaged goods, such as snacks or cereal. On price increase. Large consumer packaged good conglomerates implemented repeated significant price hikes on items like chips, cookies, and cereal. On raw material cost. While wheat and palm oil prices did spike initially, they later fell back to pre-surge or even lower levels. However, the consumer prices for the end products did not come down. On corporate profit and action, these companies explicitly cited inflation as the reason for price hikes. However, their earnings reports consistently showed that their profit margins were expanding. For instance, one large CPG multinational's gross and operating margins increased during this period of inflation, and the company celebrated its revenue growth driven primarily by price increases, not volume. 2. The energy sector. Product: gasoline and diesel. On price increase, prices at the pump reached record highs. On raw material cost, the price of crude oil is a global benchmark. While it did rise, there were periods where crude prices stabilized or fell, yet gasoline prices remained stubbornly high or fell more slowly, sometimes described as the rockets and feathers phenomenon. On corporate profit and action, major oil companies like ExxonMobil, Shell, and Chevron reported record-breaking all-time high profits, often in the tens of billions of dollars per quarter. They did not use these windfalls for significant new production to lower prices, but instead funneled massive sums into stock buybacks and dividends, directly enriching shareholders. This was a clear case of using a global supply shock, such as the war in Ukraine, as a pretext to maximize margins. Three, the automotive sector. Product: new and used cars. On price increase, vehicle prices skyrocketed. On raw material cost. While semiconductor chip shortages were a genuine supply chain issue, it does not fully explain the magnitude of price increases. The cost of steel and aluminum also fluctuated. On corporate profit and action, automakers like Ford and General Motors made a strategic pivot. Instead of focusing on selling high volumes of lower-margin vehicles, they deliberately prioritized the production of their most expensive, high-margin trucks and SUVs. They used the shortage as an opportunity to shed discounting and discipline their pricing power, leading to record per-vehicle profits and overall corporate earnings, even as total units sold declined. The corporate playbook: we had no choice. In earnings calls, executives often reveal the strategy, using carefully coded language. Pricing power. They boast about their ability to push through price increases with minimal volume elasticity, meaning people still buy the product even when it's more expensive. Margin expansion. They highlight that their net margins are growing, proving the price hikes are not just covering costs, but adding to the bottom line. Input cost. Inflation as a justification. They consistently point to past or anticipated cost increases as the reason, even when their current financials show they have more than offset those costs. Conclusion: the evidence points to market power, not a free market. The real driver is control, not cost. These examples demonstrate a pattern that contradicts the simple supply-demand model of inflation. Producers, ranchers, farmers get squeezed. They do not see a proportional benefit from rising end consumer prices. Corporate profit margins widen, not just profits. This is the key metric. If a company's costs were rising in lockstep with its prices, its margin profit as a percentage of revenue would remain flat. The fact that margins expand is direct evidence that prices are being raised faster than costs. The inflation narrative is a shield. The general atmosphere of inflation provides camouflage, allowing corporations to raise prices in unison without fear of being singled out for price gouging. In a competitive market, one company would break ranks to gain market share by lowering prices. In an oligopoly, they all have an incentive to maintain the new, higher price floor. This is not an organic market outcome, but the result of consolidated market power being exercised. The system of capital, as noted, rewards this behavior, leading to greater concentration and more control over the pricing mechanism, fundamentally altering the nature of the supposedly free market. The evidence suggests that modern inflation is better understood as a wealth transfer mechanism enabled by a highly concentrated market structure and a financial system that rewards extraction over production. The actual producer, the farmer, the factory worker, gets squeezed. The consumer pays ever higher prices. The difference is captured by the financial and corporate entities that sit at the choke points of the global economy, using their monopoly ownership positions to manage prices and extract value, all while being shielded from the discipline of a truly competitive free market. This is not an organic economic phenomenon. It is the logical outcome of a system designed to centralize wealth and control. If you like this video, please hit the subscribe button, and thank you for watching.